January 3, 2014 Real Estate Capital Scoreboard January, 2014. Chicago, Illinois, January 2, 2014. As 2014 unfolds, markets awake to a new long-term Treasury benchmark of 3% plus, a rate not seen in 2 years. The yield level has exceeded many analysts' expectations for 2013. There may be room for some volatility in 2014. Many investors remain more bearish on Treasuries and corresponding low mortgage rates, expecting rates to rise 25 to 100 basis points throughout the year. While Treasuries rates increased more than 100 basis points last year, funding sources absorbed much of these increases by accepting lower mortgage spreads. In the face of a rising rate environment, major realty capital markets trends for 2014 year include mortgage rates approaching the historical norms of the past decade, within 5.5% to 6% range for 10-year funds and about 4% for shorter-term debt. More funds available for all levels of the capital stack for property types. Investors are seeking joint venture, preferred equity and other types of funding opportunities in search of more attractive yields. Investors are pulling back on multifamily properties reach stratospheric pricing levels. Yet strong demand remains for housing in general, as more investors instead move into the single-family sector. A steady course continues on lending formats as life companies provide the best long-term debt pricing based upon lower leverage, banks tackle markets with floating rate loans and conduits pursue tertiary markets and more structured transactions. As the economy continues to recover, new construction funds are more available for retail, industrial and lodging properties, but becoming more selective on multifamily ventures. In particular, commercial properties with strong pre-leasing of 50% to 70% attract attention. Most construction lenders want to see at least 25% equity based upon project costs. More competitive forward delivery and pre-sale programs will emerge as investors seek to capture new construction deals versus tightly priced, existing project opportunities. The Real Estate Capital Institute's director, Gene Peck, advises the action in the capital markets is in the new construction arena. Projects with proven sponsorship and infill locations attract a feeding frenzy among banks. Lifecos are designing ways to compete, with a few offering new construction/perm programs.
February 3, 2014. Real Estate Capital Scoreboard February, 2014. Chicago, Illinois, February 3, 2014. The nation's frigid temperatures in the lower to mid-single-digit range accurately reflect today's mortgage rates. Interest rates during the past month have dropped precipitously at more than 30 basis points for the 10-year Treasury. And as the weather begins to improve with rising temperatures, so will interest rates as the Fed plans to curb Treasury buying activities due to an improving economy. Yet mortgage rates are expected to remain low in the near future since so many funding sources are aggressively competing for yield and the economic outlook is still uncertain. Everyone in the funding arena seems to be back in the market. CMBS markets are reporting substantially lower delinquencies, banks cleared through much of their troubled loans and life insurance companies are under pressure to capture more attractive yields from mortgages versus corporate bonds. Across the board, these funding sources are tightening spreads, offering higher leverage and less recourse, where applicable, especially for floating rate loans. The new mortgage spread benchmark appears to be 150 basis points. Rates are already extremely low, starting at this level about 50 basis points tighter than a year ago. Meanwhile, within the permanent fixed-rate sector, office, retail and industrial properties capture 10-year at rates also dipping down for lower leverage in the same 150 basis point range, but over Treasuries. Expect the 150 BPS threshold to be broken through on a more regular basis as well. In the multifamily sector, lending competition remains as fierce as ever, despite agencies' mandates to reduce loan production. More conventional lenders fill the void offering spreads over Treasuries dipping down to 140 bps per second for low-leverage loans based upon 10-year terms. Over the long term, Fed policies and investors' demand in the face of rising Treasuries are causing the flattening of the yield curve. 5- and 7-year notes continue increasing faster as compared to longer-term bonds. Under these conditions, longer-term rates will eventually rise. So for the moment, the best mortgage pricing for borrowers is for longer-term loans of 10 years or more. Ms. Jean Peck of the Real Estate Capital Institute expects, mid-100 spreads are more common today, so lenders are becoming more creative to generate greater yields. More dollars are moving into new development deals, particularly in the commercial property sector, which was severely neglected during the Great Recession. March 3, 2014 Real Estate Capital Scoreboard - March, 2014. Chicago, Illinois, March 3, 2014. Throughout February, Treasury notes moved within a tight range, settling to the same levels of the previous month. Bond investors are faced with juggling their portfolios based upon the delicate balance of inflation versus slower employment growth. At the same time, the stock market enjoys record highs, leaving little room for capturing profitable yields. These factors translate to the continued tightening of mortgage spreads over treasuries, with borrowers completely in the driver's seat. As lenders and equity capital sources refine their funding objectives for 2014, more is the most important word in their vocabulary. More capital, more creative underwriting, more flexibility, more leverage and more competition are among the mores. The following highlights illustrate this trend. Lower leverage loans are approaching historically tight spreads, while full leverage loans continue tightening, indicating that investors are pricing risk much more aggressively than in the past due to their profitability. Most mortgage rates are priced in the middle single-digit range, while high leverage, creatively structured loans approach the 7 to 8% range, indicating further tightening of spreads between various debt funding structures. Interest-only options have returned to both CMBS and Life Co quotes. Agencies remain optimistic to stay on path with their mandated funding goals, offering greater flexibility in structuring loans for multifamily properties. Many lenders have tightened their pricing by 10 basis points or more, especially for shorter-term debt of 5 years or less, as banks aggressively re-emerge in the lending arena to battle for such funding opportunities. Both life insurance companies and Wall Street have higher funding allocations, targeting more loan dollars, especially for longer-term loans of 7 to 10 years. Home ownership prospects are improving, helped by new construction and lowering credit criteria by banks. Commercial properties are temporarily paralyzed as consumers stay sidelined due to the nation's struggle with drought conditions on the West Coast and freezing weather in the Midwest and East Coasts. The desire to increase business is there for almost every lender, but tight pricing at full leverage within the mortgage market leaves little room for funding mistakes. Lenders acknowledge that now more than ever, they need to be diligent on enforcing underwriting standards but offer some creative structures if warranted by the deal, remarks Jean Peck, the director of the Real Estate Capital Institute.
May 1, 2014 Real Estate Capital Scoreboard - May, 2014. Chicago, Illinois, May 1, 2014. Global market tensions help maintain low-yielding treasuries. At the same time, real estate investors are more optimistic about the income property sector due to a slowly improving economy. Real estate pricing climbs to record levels as driven by insatiable demand and low-cost debt. Market highlights summarizing the first quarter of the year along with forward-looking trends are as follows. Development trends. You have to be dense not to understand density, indicating that high density and mixed-use vertical development is here to stay, no longer a smart growth conversation. Urbanization of suburbs shows that long-ignored, older, infill suburban areas near public transportation desirable, as pricing differential becoming more attractive versus urban deals. Increased construction and labor costs, for example, 15% in many markets, creating as much as 100 basis point lower development yields, but are compensated by lower mortgage and capitalization rates. Land costs driving higher construction costs, peaking above pre-recession levels keeping profits in check. However, financing sources are also recognizing developers' marked up values during such holding periods, creating more implied equity in construction budgets. Parking ratios continue declining, giving way to pedestrian lifestyles, bicycles, zip cars and convenient public transportation. Municipalities showing more flexibility with this component, helping to drive down overall construction costs. Property types. Development yields, return on cost range of 5.5% for major market apartments, otherwise 6% to 7% for other types of commercial properties. More retail and industrial deals in the pipeline, but office still very sparse. Apartments, new construction concerns mitigated by job growth and return to urban areas, cap rates moving down to 3% in some major markets along the coasts, otherwise 4.5 to 5.5% for other major markets with another 50 to 100 basis points for secondary markets. Retail, about 12% of all retail sales are now online, nearly no new development plans for department stores, larger grocers reconfiguring stores for smaller urban footprints, responding to more independent and local operators. The most fluid property type that's overbuilt, suburban, yet in great demand, urban infill. Tech companies are humanizing their products with stores, for example, Apple, Tesla. Industrial, national vacancy levels well below 10%, encouraging more new construction especially given shorter development cycles, and in selective markets, spec projects are acceptable. Office, excellent yield plays during the past couple of years, but longer-term ownership is a more cautious concern due to tenants' demand for more efficient space. Hotel, interest rate volatility and near-peak pricing. Everyone seems to be scrambling for certain yield opportunities. Many institutional investors are reintroducing themselves to new construction funding strategies for capturing core and core plus investment plays. Pro forma underwriting is commonplace again, according to Gene Peck of the Real Estate Capital Institute.
June 2, 2014. Real Estate Capital Scoreboard June 2014. Chicago, Illinois, June 2, 2014. Ongoing mortgage spread compression, lower treasury yields and less restrictive underwriting are today's headlines. Investors are constantly surprised about the downward movements in mortgage and capitalization rates. Many fear of being too late to the investment party, but have no choice but to accept skinnier returns given the insatiable appetite for investing in various types of commercial real estate ventures. Mirroring this trend, key real estate capital market discussion points relating to very low starting yields are as follows. Commercial properties, namely retail and industrial assets, are clearly back on the favored list with most lenders, as funding sources offer tighter spreads and pricing comparable with the most favored property type, multifamily. The lower range for mortgage rates on conservatively leveraged assets only represents about a 10 basis point variance between different properties types, except for hotel and special purpose assets. Long-term, 10-year, mortgage rates start below 4% for such type of fundings. New construction is in demand. Most types of urban infill properties including multifamily, mixed-use and retail developments. Return on cost benchmark development yields for such projects start as low as 6.5% in most markets, but can even be 50 to 100 basis points lower in gateway coastal markets. Insatiable demand for credit tenant, net leased properties generates capitalization rates starting in the higher 4% range, particularly for ground lease deals. Credit tenants are more selective on locations, creating a new construction shortage, while tax exchange investors drive the demand side of the market in direct competition with institutional sources. The Real Estate Capital Institute's director, Gene Peck, suggests borrowers are having a field day with competitive financing choices, including structured debt and equity transactions. She adds, in fact, The biggest competition for the capital stack is within the capital stack, as existing lenders and equity investors are willing to contribute more dollars into high-quality assets, pushing out mezzanine, pref equity and other types of hybrid debt vehicles from the financial equation.
July 1, 2014. Real Estate Capital Scoreboard July, 2014. Chicago, Illinois, July 1, 2014. Chicago, Illinois, July 1, 2014. June closed to an active finish as borrowers scrambled to lock in long-term rates that decreased 10 bits per second due to market fluctuations. Additional action in the mortgage markets is on the underwriting front, with lenders continuing to loosen their purse strings for borrowers in a variety of creative ways as discussed below. Debt payment options: spreads are near rock bottom, nearing unprofitable yields as compared to other investment alternatives for funding sources. Thus, few lenders will dip below 4% for 10-year funds, for example, but will offer more interest-only payments for as much as half the loan term. In addition, 30-year amortization schedules are common, especially with banks and conduits. Higher proceeds, 75% to 80% is the traditional benchmark, but many conduits offer built-in mezzanine financing to ratchet up the leverage above such levels, as long as some debt coverage is available, 1.15 to 1.20x minimum, and cash flow growth is demonstrable as with lodging and apartment properties. Loan structure: lenders are willing to consider funding full proceeds on almost stabilized properties, especially with respect to multifamily, if there is a positive leasing trend. T3 underwriting is no longer a must. Broader property types: parking garages, self-storage, mixed-use, mobile home parks, owner-occupied credit, lodging and healthcare projects are some of the property types now in vogue in addition to conventional deals, namely multifamily, retail, industrial and office assets. Pricing is also very competitive for such properties and in some cases comparable to conventional types, especially with low leverage requests. Recourse: banks normally require recourse and most other lenders need warm bodies on the carve-outs of fraud, waste and mismanagement. In select instances, such lenders will partially, or fully, waive recourse for the right sponsorships with strong credit histories, etc. Flexibility: penalty-free partial payoffs, limited reserve requirements, potential availability of extra proceeds-based future performance, reduced/capped legal fees, floor removals on floating-rate loans are just some of the negotiable options. Gene Peck, director of the Real Estate Capital Institute, states summer money is hot. Lenders are offering all types of deals and everyone's asking for a second look so as to stay in the race with no signs of easing. Borrowers rule. August 1, 2014. Real Estate Capital Scoreboard August, 2014. Chicago, Illinois, August 1, 2014. While inflation concerns grow amid signs of an improving economy, treasuries started moving upward to the highest levels in the month. Investors are reacting to strengthening job markets, even with global concerns about Russian sanctions and more recently, Argentina's default. Despite recently increasing rates, overall long-term mortgages are still priced within a favorable historical range of about 3.85% to 4.75%. Funding pressure is high as lenders face fierce competition and loosened underwriting standards. In general, everyone agrees that now is the best time to be a borrower. As low rates and higher leverage loans are more common, loan negotiations are focused on the finer points of underwriting, including choosing more flexible prepayment formats, for example, yield maintenance, defeasance, often available without any additional cost premiums. The CMBS markets are guided by minimum debt yield requirements, but are now selectively returning to debt service coverage tests to win deals. 1.2x debt service coverage is now available as an underwriting metric for higher quality commercial properties. For low leverage loans, pricing is virtually identical for different property types, as lenders are more comfortable with income property in most asset sectors. Rules of thumb are less applicable as far as understanding underwriting guidelines based upon types of lender types. For example, more banks are waiving guarantee requirements, while life companies are offering more short-term, floating-rate loans, a reversal of traditional roles. Recourse and carve-out guarantees addressed with special purpose entities, environmental insurance and lockboxes. Net worth requirements and other select non-monetary loan default provisions reduced or removed, depending upon leverage levels and sponsorship financial strength. Strict underwriting discipline seen on larger loans of $100 million or larger as less funding compete and rating agencies more carefully screen such deals. The Real Estate Capital Institute's director, Gene Peck, emphasizes, while rates are extremely favorable, expect some widening in mortgage spreads as the next couple of months due to a very large volume of loans going into securitization. Investors can afford to be more selective.
September 2, 2014. Real Estate Capital Scoreboard - September, 2014. Chicago, Illinois, September 2, 2014. Interest rates continued to decline as bond investors seek safety from geopolitical turmoil, rather than worrying about inflation fears. By the end of August, even as the U.S. economy shows favorable gains, for example, a 7-year low in jobless claims, Treasury yields reached a 15-month low due to the problems facing Europe and the Middle East. Real estate capital markets are the beneficiaries of continued global unrest. Therefore, expect another banner year for commercial and multifamily lending. Borrowers want low rates, debt investors want safer yields with some reasonable premium. Commercial mortgage markets fill the void in comparison to other investment vehicles, BBB-rated bonds, for instance. A clear sign of this investment trend includes life insurance companies increasing their allocation to mortgages, looking to raise allocations to as much as 15% of their portfolios. Ultimately, anticipation of the Fed's raising rates in the near future should pose a challenge to realty investors seeking various types of longer-term debt. But for now, with more pressure to fund longer-term commercial mortgage loans, underwriting standards are loosening based on intense competition from banks, Wall Street and life companies. The net result includes higher leverage, more interest-only underwriting and less restrictive property type and location profiles. Rating agencies and loan underwriters still maintain discipline, mainly by focusing on higher quality transactions within various sectors backed by proven sponsorship. Overall mortgage rates are regularly dipping below 4% for 10-year money, even for fully leveraged loans. Meanwhile, short-term rates remain unchanged as borrowers enjoy floating-rate debt priced at generously low levels. Property owners enjoy selling at record-high prices, or financing at record-low interest rates. Both scenarios are win-win, as pricing on realty debt and equity return to levels not seen since 2006-07. Gene Peck, the director of the Real Estate Capital Institute, advises the notion of real estate as an illiquid asset is changing, especially going into an economic upturn, though slow. Investors love brick and mortar, whether debt or equity. More and more people understand it as an institutional investment vehicle offering competitive yields with solid collateral. October 1, 2014. Real Estate Capital Scoreboard - October, 2014. Chicago, Illinois, October 1, 2014. The current theme for the real estate capital markets follows the Fed's policy of announcing that rates will remain near zero for a considerable time. The combination of global instability and fears of a strong dollar dampening the domestic economy help to assure that mortgage rates will favor borrowers. During the past few weeks, Treasury rates for medium and longer-term debt trended upward by about 20 basis points in comparison to the end of the summer, and mortgage spreads maintain a steady course. However, today, rates plummeted more than 10 basis points, landing close to the lowest levels of the year, a real roller coaster ride. With rates staying somewhat flat, lenders continue offering more creative solutions for remaining competitive, including more funding sources, especially life companies, are offering a second bite at the apple via fund additional proceeds during the loan term, leverage in excess of 80% LTV also available for select apartment funding opportunities. Fixed-rate construction/perm funding programs re-emerging as additional capital options for capturing prime-quality properties as mounting evidence backs more new construction multifamily demand in most major markets. Mortgage spreads for office properties slightly tighten and are edging closer to multifamily and industrial assets as this sector shows continued signs of recovery. Liberalized guarantee provisions for construction and permanent debt carve-outs, borrowers with loan requests of 65% or less. The Real Estate Capital Institute's director, Gene Peck, notes with mortgage rates staying in a tight and low range, investors are more confident in paying higher prices for income properties as overall yields are better matched with cheaper debt. High-quality real estate bargains are hard to find, even in secondary markets.
November 3, 2014. Real Estate Capital Scoreboard-November, 2014. Chicago, Illinois, November 3, 2014. In the past couple of weeks, mortgage rates dropped to their lowest level since earlier in the summer, only to rebound upward by about over 0.25% after the stock markets rallied to their best levels in over a year. Global anxieties overshadow an improving American economy, keeping bond yields near record low territory. Instant volatility prevails, ignited by any news outbreaks such as the Middle East, Ebola, and Russia, rattling treasuries by 10 to 20 basis points and within a day. On the other side of the equation, mortgage spreads keep declining from their historical norms. Currently, spreads are about 10 to 20 basis points narrower than the averages for the past 3 decades. The outlook for commercial real estate mortgages is strong despite erratic Treasury note behavior. A stronger domestic economy is definitely buoying commercial property fundamentals, generating a very narrow mortgage pricing band across multiple asset classes. For instance, equally leveraged office properties trade only about 5 basis points wider than multifamily assets. Industrial and retail rates are nearly equally priced. Only a month ago, the rate premiums between various property types varied as much as 10 basis points. Quickly tightening mortgage spreads occasionally create unique yield inversions, as many investors are caught off guard. In some cases, the mezzanine and preferred equity tranche is actually priced lower than the higher risk components of senior debt. Freshly priced mezz/pref equity funds were blended with older, higher priced senior debt lining up for securitization. Even all of the market instability, 2014 will shape up to be a record year for the industry. An ever-expanding list of capital sources continue to look for funding opportunities as mortgage yields are still relatively attractive in relationship to corporate and government bonds. Nearly all institutional investors now view mortgage debt as a legitimate investment vehicle as securitization data provide clear yield and performance benchmarks. Uncertainty prevails, but low interest rates are definitely supporting a strong real estate market, says Gene Peck of the Real Estate Capital Institute. December 1, 2014. Real Estate Capital Scoreboard December 2014. Chicago, Illinois, December 1, 2014. The commercial real estate industry is driven by low interest rates, as attractive property values are maintained through aggressive of both debt and equity capital. And this property values climb, in some cases peaking, money continues to flow into this investment sector. Major trends in the CRE capital markets are noted below. Stable Treasury yields are helping. During the past couple of weeks, rates flattened out, as spreads between the 5 and 10-year Treasury remain at about 70 basis points, nearly half the difference from a year ago, but above the average of 60 basis points. Such Treasury behavior clearly shows how monetary policy is influencing the slope of the yield curve. Strong demand for longer-term debt exists, as global investors look for safe haven capital. A tightening of the monetary policy usually means a rising short-term interest rates, typically intended to lead to a reduction in inflationary pressures. Declining mortgage spreads. The direct result of an oversupply of capital is declining mortgage spreads. Mortgage yields are edging downward and about 10 basis points narrower than the average for the past 3 decades. Except for lodging and special-purpose properties, rate premiums are almost non-existent among various property types, as improving market fundamentals drive more demand for funding a wider variety of commercial properties. Rationalizing risk. Bullish optimism continues to chase down yield. While profits breed competition, seeking excess profits can ruin it. Today's markets clearly surpass 2007 yield benchmarks with sub-4% annual returns acceptable to many foreign investors driven by equity multiples, rather than yield. New construction is a profit frontier measured by low-teen returns, as well as 100 to 250 basis points development yields versus exit capitalization rates. However, the biggest profits are hidden in repositioning and upgrading existing holdings, with returns often exceeding 50 to 80%. On the debt side, lenders and investors rationalize that the low rates on CRE debt remain well over that of risk-free investments and feel they are compensated appropriately for investing in this sector. Lenders are quick to institute floors if they feel base rates are dropping too quickly or deeply, thus protecting a perceived downside to the lower rates they offer. Ms. Jean Peck, director of the Real Estate Capital Institute, observes, mortgage rates are tight across all varying loan terms driven by lower treasuries and the overall perception that commercial real estate represents safety versus higher yield.